Hello guys, I am Antonio and today I am going to tell you some financial functions and how to calculate that in Excel. So yeah, let's get started. So first, let's see what is future value. So let's take an example. Let's say you have $1,000 and you put that money into bank for 6 years and you will get interest of around maybe 5%. So now we have to calculate how much money we will be getting after 6 years. We have a formula in Excel called FV, which is also called as future value. So this is the formula. In this, the rate is 5%, then the NPER, which is 6 years, then the PMT is basically the monthly payment, but here we are not doing any monthly payments, so we will keep it 0. Then the PV, which is basically the $1,000, which is our investment, and don't put anything in the type, and then our answer will come $1,340, which means after 6 years we will be getting $1,340. Now let's see what is present value. So again, let's take an example to understand this. So few years ago I gave $750 to one of my friend, but now he's telling me that he's just having $500 right now. But he also gave me another option that he will pay me $1,000, but the condition is after 5 years. Now I have to find that which is a good deal for me. So now I have to find out what is the present value of that $1,000. So I can compare that with $500. And yes, we will also need one more thing to calculate the present value, and that is discount rates. It is basically the risk-free rates, or in other words you can say the rate that we get from the fixed deposits. And usually the FD gives around 7%. So again we have a formula. So the rate is 7%. Then we have MPER, which is 5 years. Then in PMT we will keep it 0 because my friend is not going to give me any monthly installments. And the FV, which is $1,000. And then don't put anything in the type and press enter. Then the answer will come around $712. Now obviously the 712 is greater than the $500. So I'll tell my friend that don't give me $500 right now. I'll take that $1,000 after 5 years. Now the third thing, which is NPV, which is also called as net present value. So to understand this, we will again need to take some example. So one of my friend came to me and said that if you invest $1,000 in my business, then I'll give you $300 for next 5 years. Then I started thinking about the deal. Firstly, I multiplied $300 by 5 years, which comes out to be around $1,500. Now obviously $1,500 is more than my initial investment. But wait, we will also need to consider the discount rate. So let's say my other investments are giving me around 20% return. So I will expect more returns from these investments. So now we will need to calculate the NPV. By doing that, if our NPV is positive, that means it's giving me more than 20% returns. And if it is negative, then I am going to stay away from this investment. So again, we have a formula in Excel to calculate the NPV. The rate is basically the discount rate, which is 20%. Then the values 1, 2, 3, 4 and 5 are $300, which we will get for 5 years. Then after putting all the values and pressing enter, we will get around minus $85.68. That means it's negative. So I'm going to stay away from this investment. Now the last thing, and that is IRR, which is also called as internal rate of return. It is basically the annual rate of return that you get from your investment. So again, let's take an example to understand the IRR. So one of my friend came to me and said that if you invest around $1 lakh in my project, then I will give you $30,000 for next 5 years. So as in the previous example, we have calculated the NPV, but here I want to know exact how much percent I will be getting. Maybe more than 10% will be good for me. So again, we have a formula to calculate the IRR. For values, select all the values of the 5 years, which is around $30,000, and leave the guess option blank. And after putting all the values and pressing enter, you will get an IRR of around 15%. And for me, 15% is a good return. So I'll invest in this project. So yeah guys, thank you for watching the video. So today we have discussed 4 basic financial functions. The first one was the future value, then the present value, then the NPV, which is also called as the net present value, and finally the IRR, which is internal rate of return. So thank you guys and bye bye.